Hi, everybody. My name is Matt Brown, and welcome to the Direct Private Investment Show. With me in this episode is Bruce Roberts. Bruce, welcome to the show.
Great to be here, Matt. Thanks.
Bruce, fill our viewers in from around the world. Who are you exactly?
Well, I'm a career investment banker on the professional side. Actually started my career at the earlier Bank of America in 1983. That was after a stint in the Navy. And then for the first part of my career, came through a traditional investment banking route where I was working my way into supporting very large companies, doing really large transactions. About 8 of those years were in New York with a firm called First Boston, which became part of Credit Suisse and is now becoming part of First Boston again. It's being spun out. But founded Carolina Financial Group in 1995, and we quickly became a broker-dealer. We have a broker-dealer subsidiary we created in 1997. And that the firm has evolved over the years, but the basic theme of the firm has always been private finance and trying to find increasingly efficient ways to bring private capital to predominantly private companies.
Got it. So you need to evaluate issuers. What do we mean by an issuer?
Okay. An issuer in this case would be the entity, a corporate entity in our case, that's actually issuing a security, and the security being a means to transfer capital from those with money, those with capital, to those who need it, in this case, a company. So the vehicle that would move that capital is going to be a security, and typically a debt security, private lending, or an equity security, an equity investment in the company, which often is thought of as venture capital if it's a younger company that doesn't have any cash flow. But the issuer is actually that entity that is taking on the obligation of the security. So in the case of a debt security, they're making a commitment to repay the capital on a fixed schedule. If it's an equity security, then they're basically sharing the equity of the business, which represents a future participation by the investor in the upside of the company. If it's sold or could even go public or whatever would benefit the owners of the company, then they have a proportionate ownership as an equity holder.
Got it. So it's important, obviously, to do due diligence, if you like, on the issuers themselves. So how do you decide on who is a good issuer and who is not a good issuer?
Yeah, I think it's important when you're trying to evaluate a prospective investment of any kind, but particularly in the private capital markets, is you have to differentiate. There is the issuer, the entity that's responsible to meet the terms of that security, from the security itself. And many times people don't take there's such a variety of company that gets financed in this entity, in this universe, and there's such a variety of securities you can invest in. You've got to create some process to sort of guide you through it. So we do start with the issuer, because ultimately it's going to work or not based on the strength of the issuer, and also the security that's being sold. While we talk many times in terms of suitability of the security to the investor, there's also the whole question of suitability of the security to the issuer. So for example, some companies have no they should not be issuing debt at a certain part of their life cycle. And other companies are not even appropriate equity issuers because the growth of that company will never really provide a compelling return for what you would expect in a private equity investment. So starting with the issuer, for me, it's always about the customer, because the customer, if you don't have a customer, you don't have a company. And having financed hundreds of venture stage businesses at this point, and looking at the broader market where it's, for earlier stage companies, it's generally expected that you'll have a high loss rate on those. If you start with the customer, and with the customer, their why would they buy the product that the company is offering? That's a great fundamental place to start. We actually call that the lane, where you've got a company that's issuing a product. They're issuing that product to meet a need or want, and there's a difference, of a given customer. And if you have that basic perspective on the company, then that essentially helps you begin to have a basis to organize due diligence. Otherwise, you're scattershot with a lot of information, and you don't have any real point of reference of what information is more important or is more critical to the potential success of the deal.
Mm-hmm. Bruce, is there a framework that you use to create a repeatable process or outcome when it comes to presenting an issuer to an accredited investor?
Yeah, there is. We've evolved to create a framework that we call the lane. And we use that term lane because it has, I think we often talk about it, but it isn't necessarily formalized what's your lane? Where's your happy place? Where's that type of business where you can have the best chance of success, or have been the most successful? The lane has basically got two ends to it. One side of it is a customer, and that customer essentially represents a business opportunity, and that opportunity is to deliver a product or a service to meet that opportunity. So that becomes the company's lane. So often, if you don't have a lane going in well defined, you might have a product, but you're a solution looking for a problem, right? And what you really need to have is a firm says, as an investor, particularly a venture capital investor, that there's a strong focus on, here's a customer that has a need, we're providing a product or a service that can meet that need. And then once you know that, that's what they should be doing, then all of the other data that you've got can basically be organized into two primary camps. There are going to be challenges that company meets that are related to delivering the product. Frankly, that's where most venture capital analysis starts and stops, is how do I deliver the new thing to meet the need of that customer? But there's an equally important group of challenges relating to the customer. And so you have to sell that product to ever be a sustainable business with cash flow. And where we've evolved to is to try to be more balanced in that analysis, to say, fundamentally, what's the lane? Then, okay, what are the product-related challenges? What are the sales-related challenges? Then once you understand that, the vast amount of information you might get on this company, you can begin to say, okay, this particular company, regulatory issues are huge. They can't even sell a product if they don't get approved by some regulatory authority. This sort of company, there's already 5 people providing the same product. It's a very competitive situation. That would be a customer challenge. They have maybe a little bit better product, but they still got to break through the clutter of how do they get visibility. So every company is so different, but if you put it in that framework, I find it's a great point from which to begin to look at the various data that you're providing. We have a broader organization of due diligence. We maybe have 13 or 14 different categories, but if you're just filling a file with a bunch of data, you've got data but no information. And what you really want to try to do is understand these issuers. And again, in our case, one deal is so different than the other. We have to create some commonality of process.
So Bruce, I love this concept of the lane. I think it's super exciting. I'd love for you to really make that idea tangible for our audience. So could you give us a real world example of how you've applied the lane framework to evaluating an issuer?
Sure. Let's take the beauty industry. There's a lot of ways you can sell a beauty product, and companies in the beauty industry that have been successful, you talk about manufacturers of new products, are successful when they have a clear focus on a particular channel that will ultimately get their product to the end user, to a retail customer. But really, for them to be successful, they probably don't have the capital to market directly to the end consumer. And so there might be some intermediary step. For example, a lot of retail product in beauty gets sold through spas and salons. So we have an issuer that happens to have a particular focus on selling through that spa and salon channel. There's about 21,000 in the United States. So that in of itself is a big market, and they're servicing millions and millions of end consumers. Now, clearly, the end use product has to be a desirable, attractive product to the end user, to that retail customer, but they're selling through a channel partner, through a spa and salon. So if you're looking at the lane, then the opportunity, their immediate customer is the spa and the salon owner. And why is that a customer? Well, they're trying to generate more revenue per chair. They're trying to deliver a better service to their customer. But the whole organization of the business, whether it's your sales and marketing program, whether it's the way you might offer profit or shares of the margin from the product, the type of displays that you use, all of that needs to be consistent with your initial customer, which is the spa and salon owner. Yes, the end-use product, whatever it may be, has to be attractive to the end consumer, but you're never going to get to that end consumer if you aren't first able to satisfy the spa and salon owner. So that really is your lane, is that spa and salon owner. And once you know that, then all of a sudden everything starts to come in line. How do you organize your sales staff? How do you run the other software support technology you might use for sales? How do you measure your success in selling, right? And everything comes in line once you've understood, who you're selling to, what their needs are, and organizing the product and the business around the needs of that customer.
So Bruce, I've heard you talk about first principles. How does that idea of first principles apply to evaluating issuers?
Yeah. Well, first of all, I didn't come up with first principles. That goes back to Aristotle. I think that's 600 BC or something like that. But in recent years, if you follow business the way I do and many of us do, you'll find that some of the most successful entrepreneurs and successful investors of our age, that could be a Charlie Munger, working with Warren Buffett, that could be Carl Icahn, who's certainly well known in the private equity LBO space, and of a more venturous entrepreneurial side with Elon Musk. All of them have pointed to first principles as a methodology that they use. And the methodology is pretty straightforward. There is some problem out there to be solved. That problem by its nature has certain challenges, and you identify those challenges. And then if you do that, that will lead you to a solution. Now, I happen to be an engineer by training. So while we didn't use the term first principle back when I was in school in the 70s, and in fact, looking back on it, that's really what we were doing, is we were presented with a problem to solve. We gathered data. Depending on the problem, we would have some context for that data, and then that would drive us to a solution. And that's really what an engineer does every day. In many ways, we're financial engineers. The only difference here being we're presented with not just a problem and a solution, but we're trying to figure out if the challenges that we can identify are adequately addressed by the solution. And if they are, then that gives you the best chance of a successful investment.
So Bruce, once you've got a pretty good sense of the lane, then what?
Well, as it turns out, most companies are organized in a way naturally that fits pretty well with the lane as well. So, for example, the operations department for a company tends to align on the product side. Now, if it's a new product and there's R&D and research, that's going to be more heavily weighted within operations. If it's an existing product and you're really looking at scalability, then the emphasis on the operations side of the business is going to weight more that direction. And as bankers, when you look at allocation of capital, you're going to be expected to be going in that direction. On the sales channel side, well, you have sales and marketing. And sales and marketing needs to be organized in a way that addresses the challenges based on the stage of the business and based on the financial resources of the company. What you also have, though, is general administrative. So you've got management leadership, you've got finance and accounting, you've got HR. And so in that case, that's kind of three convenient buckets where when you look at the business, you can say, okay, does the operations side of the business match the product side of the business? Does the sales and marketing match the sales related challenges? And do you have something in the middle here that's going to kind of keep it all together? Senior management that's working as a team. They've got a clear financial management program. They got a clear financial plan. They're on top of their regulatory requirements. They're on top of HR. But now you've broken it into some convenient buckets, and then you can have a pretty good chance of saying, okay, got that under control. But frankly, there's no perfect company. And so what you really do, here's where it gets even more of an art, is you're saying, okay, given the nature of the opportunity, the size of the opportunity, given where they are in their development, in terms of addressing the challenges, okay, they're going to need more capital to keep going down. They need more gas in the tank. That's my money. Am I comfortable with that bet? Can they deliver, the entire business? Because when it's presented to us, particularly in earlier stage business, now you're going to find some holes in the story, but at least now you know what the holes are. That is your risk, and you can risk weight that in terms of what the projected return would be.
So Bruce, you've covered a lot of ground, but I'm very curious to understand, how does the lane apply when comparing two different types of issuers?
Well, to be successful in this world of direct private investing, I often say it's like going to the grocery where you're picking up some vegetables, and say it's avocados, and you've got either a mountain of avocados because you make your guacamole, or you've only got a handful. Well, you're going to be more discerning if you've got more avocados to look at, right? So before I answer your question, I would like to say part of the challenge of the private investor is get yourself in a deal flow where you're seeing as many deals as you can. Frankly, that's part of what we think we bring to the table is we're seeing deals all day, every day. We touch thousands of investors. Those thousands of investors themselves are investors in deals we didn't do with them. And so if and when those companies need capital, who are you going to call? We tend to get that phone call on a regular basis. But to answer your question, when you organize the various challenges the company has, then you really do get a better sense of what the stage of that business is and the risks of whether it can execute across its plan, right? Even within the same industry. So you might have two companies that are both in the med tech sector, and one company is a direct to consumer, one has to sell through a hospital. That's a completely different sales channel from one versus another. And at least you can contextualize those challenges between those two companies. On the product side, one may be a gleam in the eye. They're not making a product yet. It's just an idea, right? And it might be a really good idea, but what's the challenges of taking that idea and turning it into a deliverable product versus another company that's out there making product today, needs to scale to be successful, but at least they have a deliverable to the customer. So, this can really help you contrast one opportunity versus another and find your happy place in terms of the risk return associated with one versus another. There's a lot of stories that go with our business, and we're telling stories, and we're trying to tell a story about a company that is not just a story, but is actually giving you a tangible takeaway of, okay, I got it. I see where this company is in the scheme of things. And of course, our other job is we serve two masters, right? We serve the investor as well. So if we've done an adequate job of looking at the suitability or the investment criteria of the investor, now we're in a better position to say, okay, this deal matches what this investor is trying to achieve with their portfolio. So it cuts across a lot of things. Yes, it helps us choose which deals do we want to put our name behind and support. Because when we support investment, we're with that investment through its life cycle, not just when we place it, but we're going to support the investor throughout as long as they're holding that investment. So we want to know that the investor is getting what's most appropriate for them, and we do our best to ask them the questions that tell us.